While the world celebrated silver-breaking records, something sinister was unfolding in the shadows. In the dead of night, the power players of the financial system gathered in secrecy. Their models screamed danger. The price was heading straight to $100, threatening to bankrupt the giants. But instead of facing their losses, they chose to rewrite the rules. At 3 a.m., quietly, the exchange issued a notice. Margin requirements skyrocketed, turning everyday traders into victims overnight. Imagine signing a contract and being told, pay more or lose everything. Yet this was only the beginning. Buy buttons vanished. Orders were blocked. The market, once free, now tilted in favor of the insiders. Sell walls loomed, massive orders that existed only to scare. Every digital number was a lie, every chart a trap. The institutions weren't just playing the game, they were scripting it. And behind the curtain, the regulators and media stayed silent, complicit in the act. But this is more than manipulation. It's a spark of rebellion. Investors aren't backing down. They are buying physical silver, reclaiming what the banks try to steal. A revolution is brewing in plain sight. Every cheat, every rule change, only fuels the fight. This is not just a market story. It's a struggle between power and truth, between control and freedom. The era of paper domination is ending. The era of the people is just beginning. The night was quiet, too quiet. While most of the world slept, the giants of finance were wide awake. Behind closed doors and dimly lit boardrooms, the custodians of the silver market plotted. The price had broken $75 per ounce. Models projected $100 by next week. Panic coursed through the halls of the major bullion banks. Losses were looming, catastrophic losses. And yet, no alarms blared on CNBC. No headlines screamed the danger, because they didn't want you to see what was coming. At exactly 3 a.m., the exchange posted a subtle notice online. A new rule, a dramatic hike in margin requirements. Think about it. Imagine buying a house with a fixed contract. You sign, you plan. The next day, the bank calls, we change the rules. Pay $50,000 more, or we sell your house. That is exactly what happened to small traders. Margin calls came not because the price fell, but because the rules changed. The game was rigged while the players slept. And yet, this is only part of the story. Exchanges are meant to be referees, neutral arbiters. But here, the referees were former executives of JP Morgan, Goldman Sachs, insiders protecting themselves. The rule change was their shield. The exchange's integrity, gone. Its fiduciary duty, ignored. Every new restriction, every forced liquidation, sent a signal. The game is over unless you bend to their will. Scientific studies of market psychology, like those by Professor Robert Shiller, show that unexpected rule changes trigger panic faster than price drops. Fear spreads exponentially. In just hours, social media exploded. Traders shared screenshots of impossible margin calls. Algorithms feeding on this panic began liquidating positions automatically. The avalanche had begun. But here is the twist. The banks misjudged the human response. Anger replaced fear. People weren't selling. They were waking up to the system's betrayal. The midnight betrayal would become the spark of defiance. And as dawn approached, one question loomed over every trader. How far would the exchange go to save itself before the people reclaim control? Tick-tock. The clock of the silver market is running. Every second, margin calls tighten. Every second, the stakes rise. And the night's secrets are just beginning to surface. The morning light revealed a market in chaos. Traders logged in, eager to buy silver to ride the historic breakout. But the buy buttons were gone, disabled, restricted. Every attempt to open a new position triggered errors. Trading restricted to liquidation only, or risk management limit reached. It was a trap. You could sell, but you could not buy. The market had become a one-way street. This was not a coincidence. It was market manipulation in its purest form. By removing the ability to buy, the banks engineered an artificial selling pressure. When demand disappears, but supply remains, prices can only fall. Yet the illusion was even more sinister. On the digital order books, massive sell walls appeared. Blocks of 5 million ounces were listed at $76 per ounce. Panic swept through traders like wildfire. The charts screamed disaster. But these walls were fake. They were ghost orders, a tactic known in trading circles as spoofing. Within milliseconds, the orders vanished, never intended to execute. The banks were gaslighting the market, painting a picture of fear, convincing everyone that silver was being dumped. It was a psychological operation designed to shake the weak hands, to force retail investors to liquidate positions, while the giants covered their shorts. Market scientists and behavioral economists, including Nobel laureate Vernon Smith, have studied how false signals trigger herd behavior. Fear is contagious. When the sell walls loomed, algorithms reacted automatically. Positions were liquidated, reinforcing the illusion of a price collapse. Yet behind the curtain, demand was still roaring. Physical silver was scarce. Industrial buyers, Tesla, Apple, Samsung, still needed metal to produce electronics, solar panels, and batteries. You cannot liquidate physics. Meanwhile, social media channels exploded. Traders shared screenshots of blocked buy orders. Community forums became war rooms. Each cancellation, each ghost order, fueled outrage. People realized they weren't losing because of the market. They were being manipulated. This was not speculation. This was deception. And the suspense deepened. As the day progressed, the market oscillated between real trades and false walls, leaving investors disoriented. Every chart, every number became a question, real or illusion. The banks had created a maze, and every move felt like walking on a wire above a chasm. Tick-tock. The digital clock of the exchange counted down each millisecond of manipulation. Every fake sell wall, every blocked buy button tightened the grip. And yet, a new force was awakening: awareness. Investors were learning the truth. The illusion could deceive temporarily, but the hunger for real silver, physical, tangible, undeniable, could not be manipulated forever. The question hung in the air like a thundercloud. How long could the market sustain these illusions before the people forced reality to reveal itself? History has a way of whispering warnings, but only the attentive hear them. In 1980, the Hunt brothers cornered the silver market. Prices soared to $50 an ounce. The world watched in awe as a few individuals threatened the entire financial system. Banks trembled, exchanges panicked. In a desperate bid to save themselves, the rules changed overnight. Traders could sell but could no longer buy. Silver plummeted from $50 to $10 in mere weeks. The system had survived, but at a cost: trust. Fast forward to today. The echoes of that era are unmistakable. The same strategies are resurfacing: margin hikes, buy restrictions, artificial sell walls, paper contracts manipulated to intimidate. The same playbook, dusted off and applied by the powerful to protect themselves. The banks believed history would repeat itself exactly. They thought fear would make traders sell, panic would reign, and silver would tumble. But there is a critical difference. In 1980, demand was largely speculative. Today, industrial demand dominates. Tesla needs silver for batteries. Apple needs it for circuits. Samsung needs it for solar panels. Physics does not obey paper rules. You cannot tell a factory, liquidation only. Wait until the market obeys the banks. Industrial consumption is relentless. It cannot be manipulated by margin calls or ghost orders. The fundamentals are real. The math is indisputable. Even Nobel Prize-winning economists like Joseph Stiglitz note that markets with physical scarcity behave differently than purely speculative systems. The old tricks, once sufficient to break markets, now collide with real-world constraints. The banks are attempting a fight they cannot win, against industrial demand, against scarcity, against physics itself. The paper price diverges from reality. Premiums on physical silver skyrocket. Dealers charge 40-50% over spot. The digital numbers on the screen become irrelevant. 1 ounce in your hand is worth more than 10 on paper. The historical lesson becomes clear. Manipulation can delay the inevitable, but it cannot erase fundamental scarcity. And yet, suspense remains. Will the market repeat the chaos of 1980? Or will this era's industrial demand rewrite the rules entirely? Retail investors are awake. Forums buzz with strategy. Social media pulses with outrage. Unlike 40 years ago, today's participants are armed with information, networks, and an awareness of the stakes. TikTok. The countdown is real. The bank's attempts to recreate 1980 may push the paper market to extremes, but the physical reality of silver, mined, refined, demanded, will ultimately define the outcome. History rhymes, but physics always wins. The question hangs like a storm cloud over Wall Street. Can the power players outmaneuver industrial reality, or is the market about to witness a historical rupture unlike any in living memory? The market on screens and charts tells one story. The world of physical silver tells another. Paper contracts move in milliseconds. Prices spike. Sell walls appear. Algorithms react. It's a digital illusion of liquidity, a phantom market where trillions of dollars shift hands without a single ounce of metal moving. Welcome to the casino of the modern silver market. Meanwhile, the physical world marches to a different drum. Factories hum, electronics are assembled, solar panels are installed. Tesla, Samsung, and Apple are buying physical silver by the ton. The demand is relentless. Unlike paper contracts, industrial consumption cannot be manipulated with margin hikes or ghost orders. Every ounce shipped represents real value, real production, and a tangible necessity. Dealers report something astonishing. Premiums on physical silver are soaring. For a 100-ounce bar, buyers are paying 40%, sometimes even 50% above the spot price. The paper price, however, hovers artificially low, trapped in the bank's manipulation. This divergence, the spread between paper and physical, is proof that the market has split. There is the banker's price, and there is the people's price. The paper market can lie. The physical market cannot. Scientific research on scarcity economics confirms this. Professor Carl J. Dahlman of MIT notes that when a finite resource is hoarded or withheld from the open market, the price in the real world responds far faster than digital contracts suggest. Supply and demand cannot be gamed indefinitely. Every day, the banks delay reality. Physical buyers remove ounces from circulation, tightening the market further. And here is the tension. The more they manipulate paper, the more frustrated industrial and retail buyers become. Social media channels explode with reports of failed purchases, empty vaults, and restricted orders. Traders realize the game is rigged, but they cannot ignore the fundamental truth. Silver is scarce, and it is moving into real hands. Tick-tock. Each day, warehouses are emptied. Strategic reserves dwindle. Above-ground stockpiles shrink. The paper market may suggest calm, but in reality, every ounce taken out of circulation is a strike against the bank's control. This is not speculation. It is physics, logistics, and industry asserting dominance over digital trickery. The suspense builds. How long can the banks maintain the illusion? How long before the paper price finally collapses to meet the reality of physical scarcity? The casino may operate in milliseconds, but reality moves at its own pace, relentless, unforgiving, and inevitable. And when the gap closes, the consequences will ripple across the globe. The phantom market will crumble, and the holders of physical silver, the people, the factories, the innovators, will stand above a system built on lies. While the Western markets scrambled to manipulate silver and protect themselves, another player moved silently, deliberately, and decisively: China. Beyond the reach of COMEX regulations, beyond the influence of the U.S. banking elite, the Shanghai Gold Exchange operated on its own terms. Every action in the West was being watched. Every manipulation was noted. Every artificially suppressed price was an opportunity. China's strategy was methodical. While U.S. banks hiked margins, restricted buying, and flooded order books with fake sell walls, Chinese traders accelerated purchases of both gold and silver. Physical metal was hoarded, removed from circulation, and stored strategically. Every ounce acquired was a weakening of Western leverage. They were using the artificially low paper prices to drain the West of real assets, a silent, calculated economic maneuver executed on a global scale. Reports indicate that China's physical silver purchases have surged by more than 35% in the past quarter. Strategic reserves are growing, warehouses filling quietly away from public scrutiny. Industrial demand within China compounds the effect. Electronics, solar panels, medical equipment, all consuming real silver that no paper contract can substitute. Every ounce the West fails to deliver physically is one more ounce in China's vaults. Behavioral economist Richard Thaler has noted that scarcity combined with strategic accumulation triggers irreversible market shifts. China understands this. The Western banks may control paper numbers, but the physical reality is moving decisively into Eastern hands. This is more than a financial strategy. It is a geopolitical maneuver. Meanwhile, the messaging from Western media remains carefully curated. CNBC, Bloomberg, The Wall Street Journal, silent or dismissive about shortages and margin hikes. Analysts call silver a meme asset or dangerous bubble, but behind closed doors, every manipulated paper contract is a tool of control, not truth. The Chinese approach is the opposite: transparency in accumulation, discipline in strategy, patience in execution. Tick-tock. Each day of suppression in the U.S. markets accelerates China's acquisition. Each artificial drop in paper prices is a free transfer of wealth. Industrial users in China can plan. Factories can hedge effectively. Strategic reserves grow. Meanwhile, Western banks fight a losing battle against physics, logistics, and timing. And here is the suspense. The more the West tries to suppress silver digitally, the more it fuels the East's strategic advantage. When the inevitable divergence between paper and physical prices collapses, it will be global in scale. The West may have controlled numbers, but China controls tangible assets: the metal in hand, the supply in warehouses, the ability to power the future economy. The question now hangs over every trader, industrial buyer, and policymaker. As the East hoards and the West manipulates, who will emerge as the true custodian of silver and gold in the next decade? And how long before this silent shift sparks a financial reckoning that cannot be ignored? The banks thought they could scare the public: margin hikes, buy restrictions, spoofed sell walls. They believed fear would dominate, but they miscalculated. Anger replaced fear. Frustration became resolve. Across forums, chat rooms, and social media channels, a quiet revolution was taking shape. Retail investors weren't just logging in to trade. They were waking up to a system built to deceive. The battlefield was physical silver. Traders were withdrawing cash, emptying vaults, and demanding delivery. Every ounce removed from the system weakened the bank's ability to cover their massive short positions. It was simple math. Every physical bar purchased was an unmovable asset. Unlike paper contracts, it could not be manipulated, canceled, or erased. Each delivery demanded planning, logistics, and execution. The elite's algorithms could not stop it. This movement was not just financial, it was psychological. Behavioral studies show that coordinated action among informed participants can overwhelm centralized control. The forums buzzed with strategy. Traders shared tips, verified bullion dealers, and coordinated shipments. The physical silver market began moving faster than the paper market could react. The bank's digital illusions were losing power. Even industrial users joined the fray. Companies reliant on silver for batteries, electronics, and solar energy began bypassing traditional exchanges, creating direct supply lines with miners. Tesla, Apple, Samsung, all quietly securing physical metal. The paper market was becoming irrelevant. The physical market was asserting itself. And the drama intensified. Social media exploded with evidence, empty vaults, delayed deliveries, and frustrated brokers. The people were no longer spectators. They were participants, challenging the system's integrity. Every ounce of silver delivered to a retail investor was a strike against the elite, a recalibration of power. Tick-tock, the momentum built. The more the banks tried to cheat, the more the people doubled down. Every margin hike, every spoofed wall, every restriction became a rallying cry. The movement was self-reinforcing. Fear became fuel. Resistance became unstoppable. The climax was approaching. The paper price could falter, crash, or spike, but the reality of physical silver was immutable. Delivery was truth. Ownership was power. And when the dust settled, those holding tangible silver would stand not only with wealth, but with autonomy in a system rigged against them. The revolution is underway. It's quiet, organized, relentless. The banks may be powerful, but desperation shows weakness. And one fact is undeniable. The era of manipulation is ending. The era of the people is beginning. The market is changing. The illusions are fading. And now the question is simple. What will you do? Will you stand by, watching your future be rewritten on a screen? Or will you take action, claim your ownership, and be part of the revolution? If you want to stay ahead of the manipulation, if you want real insights into the physical silver market, if you want to see the truth behind the paper contracts, then hit that subscribe button. Turn on notifications, because every second counts, and the next wave could arrive overnight. Join thousands of investors already waking up to the reality of the market. Share this video with anyone who needs to see the truth. Comment below with your thoughts. Are you buying physical silver or watching from the sidelines? Remember, knowledge is power, but action is freedom. The era of the people has begun. Don't just watch history, be part of it.